If you've read The Barefoot Investor, you probably already know that index funds can be a low-cost and low-risk way to build a long-term investment portfolio. In this video, I'll explain what they are and how you can invest in them. There are a few different ways to invest in index funds, and even more terms used to describe them, but it's probably easiest to think of this as an investment approach rather than a set type of fund. For example, a managed fund, which is sometimes called a mutual fund in the US, is a traditional investment fund run by fund managers who buy and sell shares on your behalf. A managed index fund is pretty much the same, except your fund manager will simply select stocks based on a stock market index, like, say, the ASX 200, rather than picking and choosing stocks for you. This means index funds are generally passive in nature, and they don't need much in the way of active management. So if one stock leaves an index and another replaces it, your index fund will simply mimic that action. So you might be wondering what you're paying your fund manager for. Well, that's the point. Since fund managers don't have to do much legwork, index funds usually charge less in fees, so it's cheaper for you to invest in them. Pretty much any type of fund could be an index fund. It just depends on your fund manager's strategy. Even your super fund could be an index fund, depending on which provider you choose. That being said, in Australia, the most common type of index fund comes as an ETF. These are essentially the same as any other investment fund, being a pre-packaged stock portfolio, but you can buy and sell them on the stock exchange in the same way you'd buy and sell shares. Because most ETFs are index funds, some people use the terms interchangeably, but this isn't totally accurate. Some ETFs are actively managed, and some don't track stocks at all. So it just pays to remember that not all ETFs are passive index funds. Regardless of how you invest in an index fund, they all work on the same basic premise, that it's better in the long run to invest in a pool of stocks that mimic the market, rather than trying to beat the market by predicting its movements. Okay, yeah, we've all heard of the lucky punters that have struck gold by backing a successful company before it was famous, but generally speaking, when you look at returns across the market as a whole, there's no escaping the fact that index funds have been proven to outperform active traders. One famous and very successful fan of index funds is Warren Buffett. He believes in them so much that he once made $1 million bet that an index fund would deliver better returns over a decade than a portfolio of stocks handpicked by hedge funds. By 2017, he won that bet. Of course, this is also a reminder of one of the downsides of index funds. They don't tend to be a great short-term approach. It's also important to do your homework, because even though index funds are generally billed as the safe bet, some funds track riskier markets than others. However, if you're happier to play the long game and do your research, you might find index funds to be a great way to diversify your portfolio and achieve good returns in the future without the high fees associated with other investment approaches. If you're ready to invest in an index fund, think about what type you want to use and then sign up through a fund manager or online broker. If you've decided to invest in an ETF index fund, you can find these on most online share trading platforms. For more information on ETFs and all things investing, subscribe to the Find a Money channel or hit the link below for the full article.